Hello, and welcome back to the podcast. Thank you very much for being here. I appreciate it. As always, hey, if you guys would like to leave a review, that would be awesome. You can leave that on whatever podcast app that you are listening on. And then you can leave me, or you can subscribe on YouTube if you are watching this. I have some stuff to talk about today, and I'm actually quite excited about this because of the fact that I had a reader have a conversation with me. He'd booked his hour-and-a-half consultation and told me that he is taking his 401k money out at the end of the year just so he can get the match. And I'm like, you're what? I had not heard of that ever. And so I asked him what he is doing, and I am going to share that little tip with you today. The other thing that I am going to talk about today is the fact that you cannot save yourself into retirement. That means unless you are saving an ungodly amount of money with inflation and you are in your 30s, you are never going to have enough money in savings, not even through the policy. And you've heard me talk about this before, and I talk about this over and over, and I'm going to keep talking about it because we need cash flow at retirement. We need things that are going to produce income for us. We cannot be taking from a savings account. There is nothing we can put money in right now to make that work. But first of all, before I get down that rabbit hole, let's talk about what this trick is that he's doing. I am really super thrilled about this because a lot of you call me and say, hey, Mary Jo, we have our meeting. You're like, I don't really want to give up my match. It's a 6% match. It's a 3% match. It's a 5% match, whatever it is. I don't want to give up my match. Well, if there's this loophole in your 401k, you could take a distribution from that, okay? And it is called a in-service distribution. So this is what his HR department emailed him, and I am just sharing that verbatim. Before y'all get your panties in a bunch, I am not a financial planner. I am not an accountant, okay? There are rules in 401ks. And I've done some Googling on this. Not every 401k has this option. So you have to do your legwork. I'm not going to do it for you. This is not something that people probably know about. You are going to have to do some digging if you want to do this. Okay? I am just sharing with you what somebody else is doing that I thought was pretty cool because we don't have to give up the match. So what this guy is doing is contributing to his 401k post-tax. Most of your 401k money is pre-tax. You put it in now and you get a tax benefit, and then when you take it out later, you pay the taxes on it. What this is post-tax. You are going to tell your HR department, I want to pay the taxes up front. So I'm going to pay the taxes now, but I'm going to still contribute to the 401k so that we can get the match. Okay? They give you the match. And then what his HR department said is that you cannot take it as a hardship distribution. Okay? It is a in-service distribution. Now, this is what they say. As an in-service distribution, it is one that you receive while you are still employed with the employer. The primary purpose of the plan is to provide benefits for you upon your retirement. However, your plan permits you to request an in-service distribution. You may request an in-service distribution of all or a portion of all of your accounts if you have attained age 59 and a half. You may request an in-service distribution of all or part of your rollover account at any time. All in-service distributions will be limited to the following. You must be 100% vested in all of your accounts. So that was his thing. Now, this guy is not 59 and a half. But he is not having to pay that 10% penalty either. So if this is something that we can do, now I don't really like to share if scenarios with you guys because I think it's an absolute waste of people's time, but I honestly could not find enough information on this on Google. And gee, I wonder why, right? Because why would anybody be talking about this? Because your financial advisors or whatever brokerage company is managing that 401k, they don't want you taking this in-service distribution. Most likely, if you take out what you put in, there may not be a 10% penalty. I don't know. Again, I'm going to be very clear here. All I'm saying is check into it. If you are putting money into a 401k to get the match, you may be able to take yours out because you put it in post-tax. You may be able to take it out without penalty, but still get the match and them not take that match back. Something to check out. Most people that I know are putting money into their 401k just so they can get the match. That's the only reason. They don't want it there, but sometimes a match is hard to beat. Like, I'll be honest, if I run the numbers on a 6% match, it's pretty hard to give up that 6% because that's money that we've matched. So, and the fees don't outweigh that 6% in a lot of cases. So I have a really hard time telling people, oh, hey, go ahead and, don't contribute. No, I'm never going to tell somebody that they should not contribute. If you want to contribute, do it. If you're going to get a good match, you probably want to do that. If you want access to that money, then, and because you're farming with it or you're growing your business with it, whatever, let's do that. Let's access it if we can, okay? So we have to make sure that we can do that. All right. The other thing that I want to visit with you guys about is, and I've been talking to a lot of young clients, millennials. I shouldn't even use that word because it's kind of annoying, but you're 30 to 35, 25 to 35-year-olds, okay? I've been talking to them about saving for retirement, or they've been talking to me about saving for retirement. And they want me to go down to the illustration, age 65, what does that look like? Well, it's going to be great. It's going to be awesome. And we're going to have access to that money throughout the years, right? But we are not going to save ourselves into retirement. So I have a little calculator. And in this calculator, I can say, how much do you want to live on during retirement? What is your rate of return that you're going to earn if you put this money in the market? How much are you going to save? And so if we save 20% of our income, if we live on $100,000 today, and we save 20% of our income, that means, and we make 4% on that money every single year, no matter what. Now, you guys can all tell me 4% that you're doing better than 4%. I don't want to hear it. Because I have also a market history. And in that market history, over the last 20 years, our actual rate of return is 4.5%. Actual rate of return. Okay? So if we're going to make 4, because we're going to be conservative, if you're going to save 20% of your income, which is $20,000 a year in this case, we're going to save $20,000 a year. We're going to earn 4% on it. Okay? And we want to live like we are living today on $100,000. How much do I need saved with a 4% inflation? Because we cannot forget about inflation. If you think you're going to put $20,000 a year away and we have 4% inflation, you're not going to have enough money. However, 4% inflation in 35 years, if you are 30 today, in 35 years, you are going to need $394,000 a year to live like you are living today on $100,000. $394,000. That is with a 4% inflation. If you want to live like that and put 20% of your money away, that means that you are going to need $9.8 million to live from 65 to 85. Okay? If you die at 85. I set it up so you die at 85. $9.8 million. If you save 20% of your income, you are going to need to earn 10.5% rate of return every year to get to $9.8 million. If you're saving $20,000 a year. Now, that's a lot of numbers. So the moral of the story is, if you save $20,000 a year, you need a 10.5% rate of return to live like you're living today on $100,000. That's insane. That is with a 4% inflation. Right now, the government is telling us that our inflation is like 7.2 or 7% or something. That is what they're telling us it is. That is not what the true inflation number is on what's going on. If our country continues to print money like they are printing, you are not going to be able to save yourself into retirement. You can't save yourself into retirement now. So you have got to stop thinking that these life insurance policies are the end all. They are a tool so we can create some money, right? We can have some interest and dividends, but we can also have liquidity of that money to buy farm ground, to start businesses, to buy rental properties, to have ATM machines, whatever all these things are that I talked about in previous podcasts. You are going to need liquidity of that money so that you can create cash flow so we have money for retirement. If you are punching an 8 to 5 clock and you are thinking that your 401k is going to be the perfect tool, I am sorry, but you are sadly mistaken. The life insurance policy is not going to do it either. The life insurance policy gives you liquidity. Your 401k is going to take away that liquidity, and you're not going to be able to buy those rental properties, start that business, whatever it is. It's going to be a bigger struggle. We need to be thinking about other things in conjunction with the policy. If you look at what Nelson is talking about, the infinite banking concept, it is a concept. It is a way to think about money. It is a way to create cash flow. Nelson says when you have liquid money, you have opportunity. And opportunity is what we need to what? Create income. Make ourselves better. Do something better than what everybody else is doing. We need that. Nobody is talking about that. Stop thinking that your 401k is going to be the answer. It's not. Stop thinking that life insurance as a whole is going to be the answer. It's not. Start educating yourself on what else we could be doing with this money. Those things are super, super, super important. Okay, this is the best tool to use in conjunction, the best tool to use in conjunction with those other things. Your 401k is nothing. It's an or asset. You're going to put your money there, or you're going to start a business. You're going to buy rental properties. You're going to do those things. That's it. It's an or asset. You're either going to do this or. The life insurance is the and asset. We can put our money here and we can borrow against it and we can use it and we have the death benefit, right? We have all these extra added bonuses. That is why we use the life insurance policy. These numbers, young people are not being informed of correct numbers. And it is super scary to me. $9.8 million. You can basically say that if you are 30, you need to save $10 million to live on $100,000 and live exactly like you're living today. Not better, not worse, just exactly like you're living today. I heard a podcast. Robert Kiyosaki had a guest on, or maybe it was Robert Kiyosaki himself, whatever. They were talking about inflation and the fact that we as working individuals, inflation isn't going to hurt us nearly as much, right? Because our income should go up. We're doing other things. Who's going to get hurt are those people in retirement because their income's not going up. Their income is staying the same. Well, with 7% inflation, have they prepared for that? I talked to family just this last weekend and they're like, well, we can't go anywhere. We're not going anywhere because it's too expensive to travel. Because what? They're retired and they're on a limited budget. So now all of a sudden we've already adjusted our living. We've already adjusted what we can do, where we can go, because we only have X amount of dollars, and inflation, airline tickets are up, hotel prices are up, cost of goods are up. So now we've stopped living and doing retirement things because we only have so much money. Pay attention to those things. You need the life insurance policy so your money remains liquid, but it's going to also earn you some income. That income's still going to be important in there, but you could save for retirement, but you're going to save a lot more than 20% of your income. Guess what most people are doing? $3,000 a year into their 401k. If you make $100,000 a year, that's $3,000. Really? Is that going to get you anywhere? No, that is laughable. 3% with a 3% match is almost laughable. I meet with people that are doing 3%. It's like $1,500 a year. $1,500 a year? That's not going to get you, that's going to be a month's worth of income. I mean, even if I take this $394 divided by 12, that's $3,200 a month. You didn't even save enough all year to get you 1 month of retirement income. A 401k is not the answer. The answer is cash flow. I'm done with my soapbox. But this was super good information. If you have questions, let me know. If you have not read the books Farming Without the Bank and Life Without the Bank, please go to farmingwithoutthebank.com and grab those books. If you want the 401k information, if you want to look at what fees are, if you want more of college tuition costs, those things are going to be super important. That is all in Life Without the Bank. Okay, I don't have a lot of that in Farming Without the Bank because most farmers don't have 401ks. However, most of the younger generation that's listening to this, you guys are working off the farm and you're contributing to that 401k and IRA. So you might want to grab the Life Without the Bank book so that you can see a lot of those numbers and it may make a little more sense. If you need me, email me, maryjo@withoutthebank, and I am happy to answer that. You can leave a comment on YouTube or you can subscribe to the YouTube channel. Either way, I appreciate you. Okay, you let me know if you guys need anything. Otherwise, have a great day and we'll see you in the next podcast.